Canada has two main registered investment accounts most people know about. The RRSP gives you a tax deduction when you contribute. Your taxable income goes down, you get a refund, the money grows tax-deferred, and you pay tax when you withdraw in retirement. The TFSA gives you no deduction when you contribute. You put in after-tax money, but the growth is tax-free, and the withdrawal is completely tax-free. These are genuinely useful accounts. They also represent two different trade-offs. You get the deduction now with the RRSP, pay tax later. You get no deduction now with the TFSA, pay no tax ever on the growth. The FHSA, the First Home Savings Account, does something no other registered account in Canada does. It gives you both. You get the RRSP-style tax deduction when you contribute. You get the TFSA-style tax-free withdrawal when you use it to buy a home. The contribution reduces your taxable income today. The growth is tax-free. The withdrawal to buy a qualifying home is tax-free. You never pay tax on any of it at any point in the process. This account has been available since April 2023. It has a lifetime contribution limit of $40,000 at $8,000 per year, and a genuinely surprising share of eligible Canadians, people who do not currently own a home and are planning to buy one, have not opened one yet. This video covers exactly what it is, how to use it properly, the one rule that catches most people, and what happens if you open it and then never buy a home. The First Home Savings Account is a registered account introduced by the Canadian federal government and available at most major Canadian financial institutions since April 1, 2023. It is specifically designed for Canadians who meet the first-time homebuyer definition, which means they have not owned a qualifying home that they lived in as their principal place of residence at any time in the current calendar year or the preceding 4 calendar years. The two features that make it unusual: Feature 1, contributions are tax-deductible, exactly like RRSP contributions. If you contribute $8,000 to your FHSA in 2026 and your marginal tax rate is 40%, you reduce your taxable income by $8,000, saving approximately $3,200 in income tax. This is a real, immediate tax benefit paid the year you contribute, not deferred to some future date. Feature 2, qualifying withdrawals are completely tax-free, exactly like TFSA withdrawals. When you withdraw the money to purchase a qualifying first home, you pay zero tax on the withdrawal, not just on the original contribution, but on every dollar of growth inside the account as well. The combination of tax-deductible contributions and tax-free qualifying withdrawals is genuinely unprecedented in Canadian registered account history. No prior account has offered both simultaneously for the same funds. What can go inside the FHSA? Like a TFSA, the FHSA can hold a wide range of investments: GICs, ETFs, individual stocks, mutual funds, and cash. The account is not restricted to savings products. An investor who contributes $8,000 per year and invests in a broad market ETF inside the FHSA gets the tax deduction on the contribution and the tax-free compounding on the growth, with a tax-free withdrawal at the end. This is substantially more powerful than parking the contribution in a GIC at 3.5%. The eligibility rules, specifically, must be a Canadian resident, must be at least 18 years old, or the age of majority in your province, must be a first-time home buyer as defined above, not owned a principal residence in the current or preceding 4 years. The account must be closed by December 31st of the year you turn 71, whether or not a home has been purchased. Why opening it immediately matters even if you're not ready to buy. The annual contribution room accrues from the year you open the account, but specifically only from the year the account is open. An eligible Canadian who opens their FHSA in 2026 has $8,000 of 2026 contribution room. An eligible Canadian who waits until 2028 to open their account does not get retroactive 2026 or 2027 room. Those years are simply gone. Opening the FHSA as early as possible is one of the highest value single actions an eligible Canadian can take. Because room lost in years, the account was not yet open, cannot be recovered. Understanding that contributions are tax-deductible is one thing. Understanding what that deduction is actually worth in real dollar terms at your specific income level is what makes the FHSA feel as powerful as it actually is. The annual and lifetime limits. Annual contribution limit, $8,000. Lifetime contribution limit, $40,000. Maximum number of years to reach the lifetime limit, 5 years at $8,000 per year. The carry-forward rule, 1 year only. Unlike the TFSA, where unused room accumulates indefinitely year after year, the FHSA allows unused room to carry forward for only 1 year. If you contribute $0 in 2026, you can contribute $16,000 in 2027. The $8,000 for 2027 plus the $8,000 carried forward from 2026. But if you then contribute $0 in 2027, you cannot carry the $8,000 forward from 2026 into 2028. That room expires. This is covered in more detail in Segment 3. At $100,000 income in Ontario, an $8,000 FHSA contribution saves approximately $3,473 in income tax in the year of contribution, a return of 43% on the contribution before any investment return is added. At $150,000 income, approximately $3,713 saved. The contribution deduction is flexible. You do not have to claim it in the contribution year. Like RRSP contributions, FHSA deductions can be carried forward to a future year if it is more advantageous to claim them when your income, and therefore marginal rate, is higher. An investor earning $60,000 today who expects to earn $100,000 next year can contribute to their FHSA now, but carry the deduction forward to claim it at the higher marginal rate, effectively increasing the tax savings from $2,372 to $3,473 by waiting 1 year to claim. The growth component that multiplies the advantage. The tax savings from the deduction are immediate cash in hand, a refund you can redirect into your TFSA or invest elsewhere. The FHSA balance also grows tax-free in the meantime. A Canadian who contributes $8,000 per year for 5 years and invests in a 7% return ETF would have approximately $46,000 in the FHSA by year 5. $40,000 contributed, roughly $6,000 in tax-free growth, plus approximately $15,000 to $17,000 in cumulative tax refunds redirected elsewhere over those 5 years. Total value created, approximately $61,000 to $63,000 from $40,000 in contributions. Here is the vault, the one FHSA rule that most account holders do not fully understand, and that costs them a full year of contribution room if they are not careful. The TFSA carry-forward rule, for comparison, TFSA unused room accumulates indefinitely. If you contributed nothing to your TFSA from 2018 to 2025, every year's unused room is still sitting there waiting for you in 2026. You can contribute the full cumulative amount in a single year, $109,000 as of 2026, without penalty. The FHSA carry-forward rule, 1 year only. Unused FHSA contribution room from the current year carries forward to the following year only. If unused, it expires. The specific scenario that catches people, 2026. You open your FHSA but contribute $0. The $8,000 of 2026 room carries forward to 2027. 2027. You contribute $0 again. Your 2027 room is $8,000 plus the carried forward $8,000 equals $16,000 available. But if you contribute $0 in 2027, the carried forward 2026 room expires. It does not carry into 2028. 2028. You now only have $8,000 available. The 2028 annual room. The 2026 room is permanently gone. This is meaningfully different from TFSA mechanics and catches people who open their FHSA early, correctly, to start accumulating room, but then delay contributing for multiple years. The practical implication: you should ideally contribute to your FHSA at minimum every other year to avoid losing carried forward room. The optimal approach is to contribute the maximum $8,000 annually, which eliminates any carry-forward complexity entirely. But if budget constraints prevent the full $8,000, at minimum contribute something every second year to preserve carried-forward room from expiring. The specific mistake to avoid: opening the FHSA in 2023, not contributing in 2023 or 2024, and then trying to catch up in 2025 with all 4 years of room. The 2023 room carried forward to 2024, then expired. The 2024 room carried forward to 2025. In 2025, the maximum available room is $8,000, 2025 room, plus $8,000, 2024 carried forward, equals $16,000. The 2023 room is gone permanently. The correct approach: contribute at least $1 in each year the account is open to ensure all carry-forward room is preserved, and contribute the full $8,000 in years where budget allows. The FHSA does not exist in isolation. For a Canadian first-time homebuyer, it can be used alongside 2 other programs to maximize the tax-advantaged capital available for a down payment: the Home Buyer's Plan and the TFSA. The Home Buyer's Plan, HBP, a quick overview. The HBP allows first-time homebuyers to withdraw up to $60,000 from their RRSP for a qualifying home purchase, tax-free at the time of withdrawal, with a 15-year repayment period. The withdrawn amount must be repaid to the RRSP in equal installments over 15 years. If not repaid, the annual repayment amount is added to taxable income for that year. Can the FHSA and HBP be used together? Yes, explicitly. A first-time buyer can withdraw from both their FHSA and use the HBP in the same qualifying home purchase. This means a Canadian with a well-funded RRSP and a maxed FHSA could theoretically access up to $40,000 tax-free from the FHSA, no repayment required; up to $60,000 tax-free from the RRSP via HBP, 15-year repayment required. Total, up to $100,000 in registered account funds directed toward a qualifying home purchase. The FHSA advantage over the HBP specifically: the FHSA withdrawal requires no repayment. The RRSP HBP withdrawal requires repayment over 15 years, and, if not repaid, The annual shortfall is added to taxable income. For a buyer who wants the simplest, cleanest down payment strategy, the FHSA is superior to the HBP on this specific dimension. Use the FHSA first, maximize it, and then access the HBP only if additional capital is needed. The TFSA in the same strategy. A first-time buyer building a down payment can simultaneously hold a TFSA for additional tax-free savings that are not subject to FHSA-specific rules. The TFSA is more flexible. No eligibility restriction, no qualifying purchase requirement, no repayment required, and serves as the overflow vehicle when the FHSA is maxed. The priority order for a first-time buyer building toward a home purchase. FHSA first, for the deduction plus tax-free withdrawal combination. RRSP via HBP second, if the RRSP has been built and more capital is needed. TFSA third, for additional flexible savings without the specific first home restriction. The investment within each account. All three accounts can hold the same broad market ETFs. A first-time buyer building a down payment over a 5 to 10-year horizon with a meaningful portion in equities should understand that short-term market risk is real. The closer the purchase timeline, the more conservative the investment within the account should be. The FHSA is not a savings account by design, but a buyer planning to use the money in 2 years should hold it in a GIC or money market fund, rather than a fully equity-exposed ETF. One of the most common reasons eligible Canadians hesitate to open an FHSA is uncertainty. What if they change their mind about buying a home? What if they move to a city where buying is not realistic? What if life circumstances change and homeownership is no longer the plan? Here is the specific, valuable answer to that question, and it significantly changes the risk calculus of opening the account even for Canadians who are not certain they will ever buy. If you close your FHSA without making a qualifying home purchase, you can transfer the entire balance, contributions plus all growth, to your RRSP or RRIF, tax-free, without using any RRSP contribution room. This is a critical point worth emphasizing. Normally, contributing to an RRSP uses your available contribution room. If you have $10,000 of RRSP room, you can only contribute $10,000. An FHSA transfer to an RRSP is exempt from this room limitation. The entire FHSA balance transfers to the RRSP, regardless of how much room you have available. What this means in practice: an investor who contributed $8,000 per year to their FHSA for 5 years received the tax deductions each year, a real immediate cash benefit, watched the balance grow to approximately $46,000 inside the account, and then decided not to buy a home, can transfer the full $46,000 to their RRSP without using any contribution room. The tax deduction was already claimed and enjoyed. The growth was tax-free. The transfer is room-neutral. When the RRSP balance is eventually withdrawn in retirement, it is taxed at the marginal rate at that time. But in a lower-income retirement year, that effective rate is often meaningfully below the rate at which the deduction was originally claimed. The net result for someone who never buys a home: the FHSA functions as an additional, highly flexible RRSP contribution vehicle, with the same tax deduction on contributions and tax-deferred growth, but without the RRSP room constraint on the transfer at the end. The only difference from a qualifying home purchase scenario is that the final withdrawal from the RRSP in retirement is taxed as ordinary income rather than being entirely tax-free. Even this outcome is better than not having opened the FHSA at all. The original deductions were claimed and real, and the RRSP balance is larger than it would have been without the FHSA contributions. The timeline constraint. The FHSA must be closed by December 31st of the year you turn 71. If a qualifying home purchase has not been made by that date, the balance transfers to the RRSP or RRIF at that time. This provides a generous runway, but does set a final deadline. Let's come back to where we started. Canada has two main registered accounts. The RRSP gives you the deduction. The TFSA gives you the tax-free withdrawal. The FHSA gives you both. And no prior account in Canadian history has done that simultaneously. You now know everything you need to use it properly. The $8,000 annual limit and $40,000 lifetime cap. The one-year carry-forward rule that costs people $8,000 of room if they contribute nothing for 2 consecutive years. The real dollar value of the deduction at your specific income level. $3,473 per $8,000 contribution at $100,000 income in Ontario. The triple stack strategy with the HBP and TFSA that can build a genuinely substantial down payment from registered accounts alone. And the RRSP transfer safety net that makes opening the account near zero risk, even if homeownership plans change. The only thing standing between most eligible Canadians and this account is not the complexity. It is simply not having opened it yet. If you are a Canadian who has not owned a home in the last 4 years, and you have not opened an FHSA, that is the single most actionable thing you can do after watching this video. It takes about 15 minutes to open online at most major Canadian financial institutions, and every year you wait is $8,000 of deductible, tax-free growing, no repayment required contribution room that you will never get back.